Hello guys, so in this video, we will be talking about whether under the current market condition or economic condition, is there a recession coming or is there opportunities in the market? Okay, so first thing what I've seen, right, the US GDP has unexpectedly contracted at a 1.4% annualized rate in quarter one, which is in quarter one of 2022, means from Jan to March 2022, right? There's an annualized rate of a negative 1.4% on the GDP growth. Okay, and the reason for this is because of the supply chain limitations, inflation, and also the disruption due to the Russia's war in Ukraine. Okay, so what exactly is GDP, right? Based on what I Google or Investopia, right, the formula for GDP, it means consumption plus investment plus government spending plus export minus imports. So to put it simply, right, I'll just put it simple for you. It basically means what is the revenue. It basically means what is the revenue of the country. Okay, so what constitutes to a positive GDP, in other words, trade surplus, is when the total value of the goods and services that the domestic producer is able to sell to foreign country that exceeds more than the total value of foreign goods and services that a domestic buy. Okay, so it just means that how much the local is selling versus how much the local is buying. In this case, the local is selling more than the local is buying. Okay, so what constitutes to negative GDP? In other words, a trade deficit. So this happens when the domestic consumer are actually spending more on the foreign product over the sum of what the domestic producer are able to sell. So the local, in this case, is buying more than what the local is selling. And when that happens, it means that the export is larger than the imports. Okay, so when export means we sell, when the import means we buy. Sorry, so that means what we are selling is less than what we are buying. Basically, we are having more buying, more import than selling. That causes us to have a trade deficit. Okay, so in this, right, under the trading economics, right, as of quarter one, we can see that it's negative 1.4, right, under the GDP growth rate. And the reason for this is because of the record trade deficit and a decline in the inventory investments. Okay, so back to the article, right, we just share about this, right, about about the GDP growth has contracted by 1.4%. So from here, right, they actually explain that the main factor that weighed on the GDP was in the first quarter actually came from trade or the net export. Okay, so actually the net export have dragged on the GDP for the past 7 quarters, and the imports, which subtract from the headline, reached an all-time high, far outpaced the export. So what this means, right, the imports are larger than the exports. People are buying more than what they are able to sell. So the inventory also constitute to the subtracted from the GDP as well for the first time because of the supply chain challenge, and also the business also struggling to replenish their stocks. So that's why the inventory had also bring down the GDP by 0.84 percentage point for the first 3 months. Okay, so right, what in this article also explain, right, when the recession happens, usually it has to consider that there is a 2 consecutive quarter of negative GDP growth. Okay, so in the first quarter, it has proven, right, it has shown that, right, there is a negative GDP growth already. So the second thing that we are looking at is whether in the next quarter will it improve, or will there be a continued negative GDP growth? Okay. And the thing I want to share with you guys is about this article where they showed that, right, there's a yield curve inversion that also could potentially signal a recession that is coming. Okay, we can see based on the US inflation rate is about 8.5%. This is from Trading Economics, right? And we also can see in our daily activities because the energy price has increased by 32%, right? Because of the Russia and Ukraine war. And we can see that the food prices has jumped as well, right? Based on this, it's about 8.8%. It's one of the highest since 1981. Right, and also inflation has caused the increase in accelerated for shelter and new vehicles, right, by 4.7% and 12.4%. Okay, so all this, right, has actually caused a significant increase in the inflation rate. On the other hand, right, when we were to look at the unemployment rate, right, we can see that the unemployment rate has been decreasing. So this is a good news because there are more people are being employed. Means there are more jobs, right? But then why is there still a dip in the GDP growth? Because more people are employed, they have jobs, they're able to spend. But the thing is, right, there's a chance where people are actually employed, earning less than what they can spend. Okay, so basically what they're employed is not able to keep up to the inflation that is coming. Okay, so yield curve has been one of an indicator to show whether is there any signs of or potential signs of signals that shows that a recession that is coming. Okay, so the article, right, was on April 2nd, where based on then, right, it actually shows that the yield on the 10-year bond, right, ended at 2.38%. And then for a 2-year treasury bond, right, is at 2.44%. So this actually shows, right, that based on the past track record of the last 8 recession, it shows that when this happens, when the inverted yield curve happens, there's a potential signals of recession as well. So what does this inverted yield curve means, right, is where the short-term investments in the US Treasury bonds is paying more for the longer term. It's paying more than the longer term one. So when they flip, right, is regarded as a bad sign of for the economy. So for example, if you were to put into perspective of a fixed deposit, okay, and then in normal circumstances, if you were to put into the fixed deposit long term, it will generate a higher interest rate, right? But then if you were to put into a short term, it will generate a lower interest rate. When inverted yield curve happens, right, it kind of like flipped. When you put into a fixed deposit for a long term, you get a lower interest rate. And then in the short term, you have a higher interest rate. So for this case, right, because of this, it kind of like doesn't even make any economic sense for that to happen. Okay. So one reason why this is actually happening is because, right, the investors are selling stocks and shifting their money to bonds, right? Because they have lost the confidence in the economy and believe that the returns in bonds promises might be better than the potential losses that they can incur by holding stocks during a recession or holding stocks into a recession. So the demand for bonds actually went up. So that's why the yield, right, that is paying, right, will drop. Okay, a recession can be in. Okay, so this is gotten from Statista, right? It actually shows that the pandemic recession for 2020, the shortest in the 2 months, right? And if we were to look back in the track record, the highest, right, the longest period where the recession can happen is about 18 months. And averagely, right, you can see that the recession can last maybe about 10 months. Okay, so this is a period of length that we may expect that the recession could happen. Okay, based on the past track record. Okay, so next we want to look at how do stocks perform around recession. Okay, so based on this table here, right, this is using the benchmark of the S&P 500, right? During a recession or when recession happens, the price return were positive, right, at 45% of the time. Okay, and 12 months after a recession, right, the price return was positive about 91% of the time. 2 years later, right, the price returns was positive about 82% of the time. So, right, regardless, right, whether is there a recession or not, right, there's a probability of you still making positive return if you were to invest, right, in the market. Okay, so the past growth, right, this one is based on the S&P 500 drawdowns and the total return from the market bottom. So if let's say, right, example, the most latest season in COVID-19 sell-off, right, where the market has actually dropped by 33.8%, but then the potential returns that you can make from the market, right, is about 77.8%. Okay, the most recent one also a trade war in 2018, right, where the market has dropped by 19.6%. But when the market recovers, right, you can actually expect a return of about 37.1%. So same-wise, financial crisis, tech bubble, and the past other bear market. So this is being extracted from the source to prove to you, right, or to show to you further based on the S&P 500 charts. Okay, so this is from TradingView that I do a quick calculation, right? This is during the 2018 trade war. Okay, this is 2018 trade war. Okay, the market has actually dropped by about 18% based on what I calculated here. Okay, and then when the market recovers, right, this is the trade war. When the market recovers, there's actually a 41% upside. Okay, next, when we look at the COVID situation here, this is the COVID period, the market actually had a downside of 33%, but after its whole recovery is about 117.91. Okay, so question back to you guys after watching this video, right? Share with me your thoughts about, do you think that is a recession coming, or is there opportunity that you actually can find from the market? Okay, secondly, right, what are the companies that you will also want to look at to buy during this time? So this is a time, right, where we can find opportunities, and it's a time where we can actually start to really relook or start adding on to our shopping list, right, to really pick up stock that could potentially grow multiple times before and when the market recovery happens. Okay, so that's all I have in this video. Do share with me your thoughts in the comment as well. Okay, and I'll see you guys.